This afternoon, President Trump revealed signed letters to Japan and South Korea imposing 25% blanket tariffs on their exports starting August 1st. The Dow Jones plunged nearly 500 points as traders digested the implications, while the S&P 500 and Nasdaq shed 0.8% and 0.9% respectively. 7 nations received these form letters, including Malaysia, Kazakhstan, and South Africa, each learning their fate in the new American trade order through screenshots posted on social media. The dramatic market reaction to these announcements, combined with Tesla's 7% pre-market plunge following Elon Musk's weekend declaration of a rival political party, reflects broader market concerns about policy direction and macroeconomic headwinds.
What really matters is that government spending is not far in excess of government revenue. That's a fundamental issue that we have, where we have a deficit of $2 trillion. And we have interest payments that now exceed the entire budget of the military. In fact, that was a big wake-up call for me, was when the amount of money that we pay in national debt interest exceeded the Defense Department budget. I'm like, the Defense Department budget is very big, and interest is higher than that and climbing. That's a disaster.
Together, these developments show how political decisions and trade policies are creating volatility, even as traditional economic indicators remain relatively strong. Treasury Secretary Scott Bessent's Sunday media blitz revealed the administration's latest pivot. Tariffs would now take effect August 1st, not July 9th as previously threatened.
So I think we're going to see a lot of deals very quickly. And Dana, we're going to send out probably 100 letters to small countries where we don't have very much trade. And most of those are already at the baseline 10%.
This 3-week reprieve sent mixed signals through global markets. Commerce Secretary Howard Lutnick confirmed the new timeline while standing beside Trump, who cryptically suggested some deals had already been struck. The European Union claimed progress toward a framework agreement after Commission President Ursula von der Leyen spoke with Trump Sunday evening. Yet beneath this diplomatic dance lies a more troubling reality: the president's threat to impose an additional 10% tariff on any nation aligning with anti-American policies of BRICS injected fresh uncertainty into an already volatile trade environment. South African citrus farmers, whose fruit fills American supermarket shelves each summer, face potential 31% tariffs that would effectively end a quarter-century of trade relationships. These are not abstract policy debates. They represent real economic disruptions rippling through supply chains from South Africa to California. Meanwhile, the feud between Elon Musk and Donald Trump offers a particularly vivid illustration of how political factors translate into market volatility. After spending millions supporting Trump's re-election and briefly heading the Department of Government Efficiency, or DOGE, Musk broke with the administration over the recently signed tax and spending bill. His announcement of the America Party prompted Trump to call the billionaire a train wreck who had gone completely off the rails. Tesla investors are already grappling with a 13% decline in global sales. Watch their holdings evaporate further as the CEO dove deeper into political waters. This spectacle might seem like mere Washington theater, but it reflects deeper economic tensions. The tax bill that sparked Musk's rebellion is expected to add an estimated $3.4 trillion to federal deficits over the next decade. A sobering analysis from Yale, Wharton, and the Congressional Budget Office warns that the U.S. deficit now exceeds 6% of GDP, roughly 63% higher than the 5-decade average. More ominously, interest payments have crossed a historical red line, surpassing defense spending for the first time. June's employment report offers another glimpse into the economy's underlying vulnerabilities. The headline number, 147,000 new jobs, masks troubling details. Half came from state and local government, largely a statistical mirage created by seasonal adjustments. The private sector added a meager 74,000 positions, marking the weakest showing in 8 months, with healthcare accounting for nearly all of the gains. Meanwhile, 329,000 Americans dropped out of the labor force entirely, many of whom were discouraged by their job prospects. Los Angeles offers a ground-level view of these abstract statistics. Immigration raids have arrested over 1,600 workers in recent weeks, disrupting construction sites already struggling to rebuild after January's devastating wildfires. Public transit ridership dropped 15% as workers went into hiding, the first decline after 30 months of gains. Real estate developers report crews abandoning job sites, with some contractors moving portable toilets from curbs to backyards to shield workers from view. The region needs 70,000 additional construction workers by mid-2026 to rebuild. Instead, its existing workforce of 445,000 is shrinking. Meanwhile, market indicators flash warning signs even as major indices hover near record highs. Bloomberg Intelligence's sentiment gauge swung from panic in April to approaching manic in June. History suggests such euphoria precedes small cap underperformance. After previous manic readings, the S&P 500 outperformed the Russell 2000 by 178 basis points over 3 months. The pattern repeated after Trump's re-election, when sentiment hit manic levels in January, followed by a 14% Russell 2000 decline through April. Oil markets added another layer of complexity as OPEC Plus announced larger than expected production increases, causing Brent crude to fall below $68 per barrel. Gold eased to $3,325 an ounce as traders sought clarity on trade negotiations. The industrial metals complex weakened broadly, with copper falling for a third day despite recent supply tightness. On to the week ahead. As trading resumes after the July 4th holiday, American markets face a week that could reshape global commerce. Trump promises announcements on deals with 18 major trading partners, while threatening others with rates ranging from 10% to 70%. The administration's ability to juggle these negotiations while managing domestic political factors and mounting fiscal pressures will test whether the economy's apparent resilience is genuine or merely another case of what investors call fighting the last war. Monday's futures suggest traders are not waiting to find out. To read more insights, follow my newsletter on Substack, linked down below.